£1,000, that's what you have right now, and you want to invest it. And you don't want to watch a video that first starts with get an emergency fund, get a contingency fund, or even get a bank account. You know all that. And well, that last one is necessary and beyond basic. But seriously, everyone has to start somewhere. Having £1,000 to invest is a great start. I'd be investing from the moment I had some savings and then some spare cash beyond that, even if that was £50. Starting is the most important thing. But you already know that because you've tapped on this video and you've got £1,000 to start with, but you're not quite sure where you want to put it. Stocks, mutual funds, ETFs, crypto, property. Is it even worth it with just £1,000? Or are some of those out of reach because of how much you've got? Well, let's break each of these down. In this video, I'll cover, is it even worth it with £1,000? What are your options? Should you split this across a bunch of different things or pile into just one? Where to start and what kind of return you can expect? So let's kick off with, is it even worth it with £1,000? My simple answer to this is yes. But to see this for yourself, you've got to start thinking in relative terms, not absolute. What do I mean by this? Let me explain. If you have £100 and you make £10 from this, making your total £110, then you can look at this in two ways. You've made £10. This is an absolute return. And the other way to look at this is you've made 10%, a relative return, relative to what you started with. So looking at it first from an absolute perspective, there isn't a huge amount you can do with an extra £10. It doesn't sound like a lot, and frankly, it isn't. I'm giving it to you straight. There's no point saying it any other way. But when you start looking at it from a relative perspective, a 10% return is a good return. It's a lot more than you get in interest from savings in a savings account. And in the UK at least, it's double what you're going to be paying on any sort of mortgage. There's another way I like to look at it too. Let's say you've made that 10% return by investing in the stock market in some way. How else would you make a 10% return for doing next to nothing? And this question is the same for the absolute way too. How else could you make £10 for doing next to nothing? And then consider how making £10 for doing next to nothing would make you feel. Go on, tell me how you'd feel. It's the beginning of one of the easiest passive income streams you'll ever have. In crazy simple terms, this £100 has the ability to give you £10 passively for life. Yes, for life. Whilst you're absorbing all that, let me tell you another thing. Those first milestones, making £10 or £100 passively, are the hardest milestones to hit, and they take the longest. As you go up the ladder of wealth, the time to get to each next level decreases, because that money you make from investing 1 year itself starts working for you in the next year, and the year after that, and the year after that, and so on. Now that example assumed you had £100, but you have £1,000, right? So let's use the same 10% on that. You've now made the same 10% in relative terms, of course, but this time you've made £100 in absolute terms. So you now have £1,100. In 1 year, £100, almost completely passively. The same effort as making £10 out of £100, but 10x the return. Now your starting point for the following year will be £1,100, and your return therefore in the next year will be higher than £100. It keeps increasing year on year. Now, what are your options? For investing, there are as many options as you want, but there are different levels of the game. At the simplest level, there are bank accounts which earn you interest. And actually, not even for me, it isn't investing, and don't let anybody tell you different. It's a way of making a return, but it's not strictly investing. I mention it here simply to make that point. In fact, when you put your money into a bank account, even if it's a savings account, you are effectively handing over your money to a bank who then lends that money to other people to make themselves more money. i.e. they're investing your money, not for you, for themselves. And even in a high interest savings account, you get a tiny sliver of what they make back. Proper investing doesn't work like that. Investing comes with more risk, but also greater returns. And not all investing is equal. Different investing options come with different levels of risk. And typically, though not always, as the level of risk goes up, so does the potential return. We all understand returns, right? The amount of money you earn from an investment. But whilst we all intellectually understand risk, I'm not so sure we all really get it until we experience it for ourselves. I can illustrate this very easily with two simple questions. The first question is, what type of return do you want on your investment? Go on, think about it and say it out loud. Now I know there will be some of you that will have shouted out a big number. Let's say that is 30, 40% or even more. Some of you will have shouted out even higher numbers, 100% or 1000%. And then some of you will have been very meek and said 5% or 8 to 12% if you know about long-term stock market averages. Okay, now the second question. How much risk are you willing to take in losing some of your investment? Even before you've had a chance to think about it, to really think about it. I know a lot of you will have felt a surge of fear somewhere in your body. That feeling of fear, even if it was small. A lot of us know that that risk is there, but at the same time, we don't think it will happen to us. That's for others. I, of course, will only ever see my investment go up. And this is why I say I think we intellectually know about risk, but we don't really know about it. If you're investing for a long period of time, and you should be, then you will see some losses along the way. That is almost certain. And the reason you should invest, despite the fact that you will see some losses along the way, is that not investing will leave you worse off overall over the long term. Not investing at all over your life is riskier. And I know you know that intellectually, but you don't really know that. Over a long period of time, if you are prudent with your investment choices and don't make rash decisions based on emotion alone, you will almost certainly do well over the long term. That's what you need to know. Everyone, and I mean everyone who has been investing for some time, has seen losses. But if you're making smart, prudent investment choices, those losses don't wipe you out. They are part of the course, but they don't wipe you out. They're a blip. Let me give you two quick examples on that. During the financial crisis in the late noughties, my investment portfolio took a massive hit, like many other people in the world. And did I experience fear? And what I can tell you is when you see your portfolio value going down, it does generate fear somewhere in your body. But I didn't act on that. I know that crashes happen. For whatever reason, crashes do happen. There are shocks to the system, the economic system, the world, your region, your country, whatever. There are going to be blips along the road. But if you look at any stock market over a multi-decade period of time, the direction is up. Investing isn't a straight line up. It's a squiggly line pointing up. The direction, as long as you're making good, sensible choices, is up and to the right. So knowing that and your tolerance to risk, you need to make some choices. I'd mentioned 5 investment choices right at the top of this video: stocks, mutual funds, ETFs, crypto, and property. Let's look at each of them in turn to see what the risk and return looks like. For stocks, now if you're picking individual stocks, I see that as a high risk, high return strategy. Mutual funds, on the other hand, I consider low risk and they provide an average rate of return. And I'm talking about index mutual funds here, not the actively managed kind. I'll link to a video on index funds that I've done recently up here somewhere. So that's mutual funds, which I consider low risk but an average return. Then there are ETFs, which are mostly the index fund variety, and again I'll consider them low risk and an average rate of return. Then there's crypto, which I consider very high risk but also very high return. And then property, which I've seen as average risk and average return. Now this is just my view from experience over the years and decades that I've been doing this, as well as from what I've read, seen happen to others, and the broad view of people who are involved in these investment types. I'm involved in all of these, though I should point out I no longer buy individual stocks. I still own a few individual stocks from those I bought quite a long time ago, and just have them sitting there in the background. But even as I say that on this video, I'm thinking I should be selling those and putting those into index funds. I just haven't done it yet. And as I said before, I also don't buy actively managed mutual funds. These are those types of mutual funds that have a fund manager that is supposed to take particular bets on stocks based on their experience and the analysis and research that they're doing on individual stocks. But despite this analysis and research, statistics show that they rarely, if ever, outperform simple index funds. And then they have the audacity to charge higher fees for subpar performance. I just steer clear. I only buy index mutual funds and index ETFs. And I have a limited amount of money in crypto, which I aim to get to 5% of my overall portfolio of investments over time. And I also own property in the UK and in Dubai. Now, just for transparency, I'm involved in other investments too. But with £1,000, these are the 5 areas I'd look at. Now, should you split your £1,000 investment across a range of things or pile into just one? With £1,000, and especially if this is your first £1,000 going into an investment, you need to wet your beak, dip your toe in the water. I would split the £1,000 in this way: 50% into a Vanguard index fund, either Ruseda or VUAG. And actually it would be Ruseda because VUAG's an ETF. And I'd prefer to go for an index mutual fund because with £1,000, I don't really want to be paying a dealing or transaction charge on a purchase if I don't have to. Then 40% would go into a property platform like London House Exchange. This will get you into the UK property space and help you learn what to look for, how properties are presented as an investment, rental yields, cash flow, etc, etc. And then I'd put 10% into crypto and only Bitcoin at that. So that's a 50-40-10 split. And if you don't want to do property right now, then it would be 80% into the Vanguard index fund and 20% into crypto. That's an 80-20 split. And I do it in one of these two ways because I want multiple levels of growth within my portfolio. I want exposure to high risk, high return stuff, but alongside that, also good average returns that have been delivering in a consistent way for 50 plus years. There's a quote in the book, The Psychology of Money, that I love. Getting average returns for an above average period of time puts you in the top 5% of investors, or something like that. And if you've got £1,000 and you're just starting out, you should be striving to get into that top 5%. 5%. I mean, why the hell not? Now, of course, you can play around with those portfolio splits based on what you want to try out and your risk and reward ratios. But whatever you choose to do, my tip for you is don't keep checking your investments every day. That's not what your investments are for. You might want to work towards building up your investment portfolio to be able to live a great life. So that's investing to live better. But you certainly don't want to be living to invest. As I said before, all investments carry risk, and most investments by their very nature fluctuate over time, particularly short periods of time. They will go up and they will come down. Let's just quickly look at the FTSE 100 as an example over the last 40 years. Can you see all these dips? That's when the market crashed. But you'll see these points too. The market recovered and went on to even higher highs. Let's also look at Bitcoin since its inception. Here are lots of dips here too. But again, recoveries happened and it went on to even higher highs. And I'm not saying here that the trend will go on this journey forever, though I think it probably will. But what I'm saying is turbulence is normal. Crashes and recoveries from those crashes is normal. As long as you don't take action in a panic, you can ride the storm. You will be better off for it. So now you've made your choices. Where do you start? What steps do you need to take? Now I'm in the UK, so this is going to be through that lens. You will have other options depending on where in the world you are. For index funds, I'd go through Vanguard directly or through Hargreaves Lansdown. If you're buying Vanguard index funds or Vanguard ETFs, then go directly to Vanguard. It makes sense. You can avoid a platform fee by doing this, and their funds are very low cost. If you're thinking about non-Vanguard funds, then Hargreaves Lansdown will be a better choice. They currently charge a 0.45% platform fee, and this will be on top of any other fund fees. If you're thinking about property, then London House Exchange is the one I'd go for. With them, you can scour the available properties, see what their valuations are, where they're based. You can see floor plans, the investment strategy behind the purchase of that property, the expected dividend yields, and see from there which ones you want to go for. Then for crypto, it would be Coinbase or Kraken. And again, it would be Bitcoin only. With your first £1,000, just Bitcoin. Now, what kind of return can you expect? I understand why this is a question a lot of people have, but it's equally a tricky one to answer. The biggest counter question I have to this is, over what time frame do you expect a return? Any sort of return. And I ask this because over a 1 to 9 year time period, I'm not even going to guess, let alone try and forecast, as there's so many factors to take into account. It's just not worth it. And even if I could somehow analyze all these different factors, I wouldn't be able to do it with any level of confidence. Can you imagine if you were investing in the summer of 2019 and asked this question? No one could predict where your investments would be in summer 2020. Now, over a 10 to 20 year period, I'd expect returns from your index fund investments to be around the 10 to 12% range. For any UK property, I'd expect it to be in the 10 to 20% range, with rental income and capital appreciation taken into account. And crypto, well, who knows? It could be minus 50% or less, or it could be 500% or more. This is why I think these two are balanced approaches and why I went for the splits that I did. There's more videos on my channel if you want to delve deeper into any of these topics. Or if you have a question on anything I've talked about, then drop it in the comments below, and I'll see if I can cover it in a reply or in a future video. One key video that I definitely recommend for you to see next is this one over here. It's a simple way of understanding how to manage your money when it comes in. It's a little over 5 minutes, and trust me, it'll change how you look at the way you handle your income forever.